Let me tell you something that took me years to understand. And once it clicked, it changed everything. Most traders believe success comes from finding the perfect setup, mastering a specific pattern, or learning some hidden technique that professionals supposedly know. But that is not where real success comes from. Success in trading comes from understanding your own mind, and more specifically, understanding how position size affects your ability to think clearly. I spent decades working with traders, successful ones, struggling ones, highly intelligent ones who failed, and average ones who succeeded. And I noticed something consistent across all of them. The traders who survived were not always the smartest. They were not the ones using the most complex systems. They were the ones who understood the relationship between risk and psychological clarity. Let me explain what I mean. When you first start trading, you bring certain beliefs with you. Beliefs about what success looks like. Beliefs about what it means to be good at something. In most areas of life, bigger is better. More effort leads to more results. Intelligence should be rewarded. Hard work should pay off. These beliefs are deeply wired into us. So when we enter trading, we naturally assume the same rules apply. We think bigger trades mean we are more committed, more confident, more serious about making money. We look at a small position and feel like we are playing it safe, like we are not really trying, like we are being timid or afraid. And when we look at a big position, we feel powerful. We feel like we are finally doing something meaningful, like this one trade could change our account, change our life. But here is the problem. The market does not care about your feelings. It does not care about your confidence. It does not reward effort, intelligence, or commitment. The market moves based on probabilities. Your job is to align yourself with those probabilities, not to prove something, not to make a statement, but to execute your edge again and again without interference, and interference comes from emotion. Emotion comes from risk that is too large for your nervous system to handle. Let me describe what happens inside your mind when you take a trade that is too big for you. At first, you may feel excited and energized. This feels like the one. This feels like the trade that will make a difference. But then, the market moves, maybe slightly against you, or maybe in your favor before pulling back. And suddenly something shifts inside you. Your breathing changes. Your focus narrows. You start watching every tick. Every candle becomes personal. Every move feels like it is saying something about you. At this point, this is no longer trading. This is survival. Your brain has detected a threat. Not a physical threat, but a threat to your sense of security, your sense of self, your sense of being okay. And when your brain enters survival mode, it stops being rational. It stops following rules. It starts making decisions based on fear and urgency. You begin thinking things like, I should have taken profit earlier. I cannot afford to lose this trade. Maybe I should move my stop just a little. Maybe I should exit now before it gets worse. These thoughts feel logical in the moment. They feel like smart, protective decisions. But they are not logical. They are emotional reactions, disguised as logic. And the reason they appear is not because your strategy is wrong. It is because the risk is too large for your mind to handle objectively. Here is something most traders do not understand. Your ability to follow rules is not a character flaw. It is not about discipline in the way people usually think. It is about whether your nervous system feels safe enough to allow you to follow the rules. When you are calm, following rules is easy. You know what to do. You trust your system. You execute without hesitation. But when you are afraid, following rules becomes nearly impossible because fear overrides logic. That is exactly how survival works. If you are being chased by a predator, you do not stop to analyze strategy. You react. You do whatever feels necessary in that moment to survive. When your position size is too large, your brain treats a losing trade like a predator. It interprets drawdown as danger, and it takes control of your decision-making to protect you. This is why traders repeat the same mistakes again and again. Not because they do not know better, but because they are trading in a mental state where their brain will not allow them to do better. Let me walk you through the most common mistakes that come from oversized risk, because I saw these patterns in almost every struggling trader I worked with. First is hesitation. When the risk is too big, you start second-guessing your entries. You see your setup. You know it is valid, but you hesitate. You wait for extra confirmation. You talk yourself out of the trade. Then the trade works, and you feel frustrated and angry at yourself. You promise to take the next one, but that one also feels risk. Why? So you hesitate again. Or worse, you enter late after the best price is gone, and then you get stopped out. This creates a destructive cycle. You lose trust in yourself. You cannot execute with confidence. And your results suffer, not because your strategy is bad, but because fear is controlling your timing. Moving your stop loss. This is one of the most damaging habits in trading, and it almost always comes from risking too much. You enter a trade with a logical stop based on structure, volatility, or system rules, and at the time it feels reasonable. But when price approaches that stop, the loss suddenly feels unbearable. You cannot accept it, so you move the stop a little further away. You tell yourself it is because you believe in the trade, but that is not the real reason. The real reason is that the loss feels too painful to take. Sometimes the trade comes back and you feel relieved, you feel justified, but most of the time it does not. And by moving your stop, you turn a small loss into a much larger one. You break your risk management and you create a pattern that slowly destroys your account. Third is cutting winners early. When you have a large position on, profit feels fragile. It feels like it could disappear at any second. So when the trade moves in your favor, you feel an intense urge to lock it in before the market takes it back. You exit too soon. Then you watch price continue without you, and you feel frustrated. But this is not a targeting problem. It is a position size problem. With smaller size, that urgency disappears. You let the trade run. You allow your edge to play out. Fourth is holding losers too long. This may sound contradictory, but it comes from the same root issue. When a trade moves against you and you are risking too much, you freeze. You cannot execute the exit. You hope it will turn around. You tell yourself it is temporary. You hold past your stop. You break your rules. You hold because accepting the loss feels like failure. And by the time you finally exit, the loss is far larger than it should have been. All of these mistakes come from the same cause. The position size is too large for your mind to handle, and your mind tries to protect you in the only way it knows how, by taking control away from your rules and handing it to fear. Now let me tell you what happens when you trade with a smaller position size, a size that feels almost too small, a size that does not make your heart race. First, you become emotionally neutral. When the risk is small enough, the trade stops being personal. It becomes just another execution, another opportunity for your edge to express itself. You place the trade, and you do not obsess over it. You manage it according to your rules, but you do not attach your identity to the outcome. This is the mental state where good trading happens. Second, you can follow your rules without internal conflict. Your stop makes sense, and you respect it. Your target makes sense, and you allow price to reach it. Your entry criteria are clear, and you execute without hesitation. There is no internal argument, no emotional negotiation, just calm execution. Third, you allow probabilities to play out. This is the most important part. Trading is a probabilistic game. Your edge is not that you win every trade. Your edge is that over a large series of trades, your system produces more profit than loss. But for that edge to work, you must let it work. You must execute again and again without interference. And the only way to do that is to trade at a size where each individual trade does not matter too much. When each trade is just one out of hundreds or thousands, you stop trying to control the outcome. You stop needing to be right. You stop caring whether this specific trade wins or loses. You simply execute and allow the numbers to do what they are designed to do. Fourth, consistency becomes possible with small size. You can trade the same way every day. You show up calm. You execute without drama. You build a track record based on process, not luck. And over time, that consistency compounds, not because you took massive risks, but because you avoided massive mistakes. Now let me talk about ego, because this is where most traders get stuck. Trading small feels like you are not trying hard enough. It feels like you are settling. It feels like playing it safe. And for someone who is competitive, driven, and hungry to succeed, this feels wrong. You believe real traders take big risks. You believe confidence means betting big. You believe playing small is for losers. But that is your ego speaking, not your rational mind. Your ego wants to feel important. It wants to prove something. It wants to win in a way that looks impressive. But the market does not care about any of that. The market rewards the trader who removes ego from the equation, the trader who can execute without needing to feel powerful, the trader who can accept small wins, small losses, and simply keep going. Here is the truth your ego does not want to hear. Trading is not personal. The mark. ET is not testing you. It is not judging you. It is not rewarding your confidence or punishing your doubt. It is simply moving according to probabilities. And your job is to participate in those probabilities without distorting them with your emotions. When you take a big position, you make it personal. You turn a probabilistic event into A. It turns trading into a referendum on your worth as a trader, and even as a person. And that is a game you can never win. There is another reason traders are drawn to big positions. They believe it gives them control. They think if they risk more, they can make more. If they stay focused, confident, prepared, they believe they can force the trade to work. But this is an illusion. You do not control the market. You do not control what happens in the next few minutes or the next few hours. You do not control whether a specific trade wins or loses. The only things you control are your execution, your risk, and your response. And the larger your position size, the less control you actually have. Because the larger the position, the more your emotions interfere. You second-guess more. You deviate from your plan more. Trading small is not giving up control. It is taking control back. Control over your mind. Control over your process. Control over your ability to stay in the game long enough for your edge to work. Let me share something I learned over many years that separates traders who make it from those who do not. The goal is not to make money, at least not at first. The goal is survival. Survival means staying in the game. It means not blowing up your account. It means not quitting because you are emotionally damaged and burned out. And survival requires humility. It requires patience. It requires prioritizing process over results. When you trade with large size, you are prioritizing results. You are trying to force the market to give you what you want, and the market does not respond well to force. But when you trade small, you are prioritizing survival. You are saying that you will protect your capital, protect your mind, and give yourself space to learn, to grow, and to build consistency. Over time, survival leads to profit. Not because you took massive risks, but because you compounded small edges without self-destructing. Let me talk about compounding, because most traders misunderstand it. They think compounding means huge returns, doubling accounts quickly, getting rich fast. But that is not compounding. Compounding is what happens when you can execute consistently over a long period of time without blowing up. It is the result of staying in the game, avoiding catastrophic mistakes, and allowing your edge to express itself over hundreds or thousands of trades. The only way to do that is to trade at a size that allows you to stay calm, rational, and consistent. When you trade too big, you interrupt the compounding process. You have a good week, and you give it all back in one bad trade. You build your account, then destroy it trying to force a big win. But when you trade small, you create the conditions where compounding can actually work. You are not sabotaging yourself. You are not letting fear or greed derail your process. You are simply showing up day after day, trade after trade, letting the numbers do their job. And over time, that adds up to something meaningful. Not because any one trade bubble as important, but because you stayed in the game long enough for the edge to work. Here is something you need to truly understand. Your edge is not about being right. It is about what happens over a series of trades. A good system might win 50, 60, or even 70% of the time, but even with a high win rate, losses are guaranteed. And if you are trading too big, those losses will crush you. They will damage your confidence. They will make you question your system. They will push you to break your rules. But when you trade small, losses are just part of the process. They do not hurt. They do not mean anything. They are simply data points in a larger statistical outcome. When you accept losses as normal, you stop trying to avoid them. You stop moving stops. You stop hesitating. You stop cutting winners early to avoid pain. You simply execute and let probabilities play out. That is when your edge starts working, not because you forced it, but because you stopped interfering with it. From watching successful traders, I learned this. They are not the ones with dramatic stories. They are not the ones who made everything on one lucky trade. They are not the ones who took massive risks and got lucky. They are the ones who are still here, still trading, still calm, still consistent. They are durable. Durability comes from trading in a way that does not burn you out, that does not trigger your worst impulses, that does not put you in a position where one mistake can end everything. Excitement is overrated. Excitement gets traders into trouble because excitement is just emotional intensity, and emotional intensity is the opposite of what good trading requires, what goo. Trading needs is calm, clarity, and consistency, and you get that by trading at a size that feels boring, a size that does not spike your adrenaline, a size that allows you to focus on execution instead of outcomes. Let me bring this together. Trading is not about making money directly. Trading is about executing a process that has an edge, a process that works over time. Your job is not to control the outcome of each trade. Your job is to execute the process as cleanly as possible, without interference, without deviation, without letting emotions hijack your decisions. The only way to do that is to remove emotional intensity from your trades, and the only way to remove emotional intensity is to trade at a size that does not trigger your survival instincts. When the risk is small, you can focus on the process. You can ask yourself whether you followed your rules, whether you executed your system, whether you managed the trade correctly. And if the answer is yes, then the trade was a success, regardless of whether it made or lost money. In the long run, good execution leads to good results, not perfect results, not winning every trade, but consistent results that you can build on. Ask yourself what success really looks like. Most traders define success by profit, by how much money they made this week or this month. Measure it differently. Measure success by execution, by how calm you stayed, by how closely you followed your rules, by how little emotional interference you had. Because if you execute well, profit will come over time. And if you cannot execute well, profit will never last. Stop measuring yourself by outcomes you cannot control. Start measuring yourself by the process you can control. Did you trade at a size that allowed you to think clearly? Did you follow your rules? Did you manage risk correctly? If the answer is yes, then you succeeded, even if the trade lost money. Because you are building habits that lead to long-term success. When you finally embrace small position sizes, something changes. You feel free. Free from constant anxiety. Free from obsessive monitoring. Free from fear of ruin. You can place a trade and walk away. You can let it work without trying to control it. You can take a loss without feeling destroyed. And that freedom changes everything. When you are free from fear, you can finally trade the way you are supposed to. You see the market clearly. You execute without hesitation. You follow your plan without internal conflict. Trading stops being a battle or a test of your worth. It becomes a calm, methodical execution of a process with an edge. Trading is already hard enough without making it harder on yourself. The market is unpredictable. Your edge is probabilistic. Individual trade outcomes are random. But your process does not have to be. Your execution does not have to be chaotic. Your emotions do not have to control you. You can create an environment where good trading is possible, where you can execute your system without interference, where your edge can work over time. And that environment begins with position size. Trade small, smaller than feels significant, smaller than feels exciting, small enough to stay calm, small enough to follow your rules, small enough to survive. Because survival is the foundation of everything else. And if you survive long enough with consistency, the LTs will take care of themselves. Not because you forced them, but because you created the conditions where your edge could finally express itself. That is the truth about position size. And if you let it, it will change your trading.